Well, after yesterday's stronger than expected GDP data, we've had CPI come in at 4.8%, where the expectation was for 5%. Your overall impression of those numbers?
Yes, they're good numbers. Nothing in the numbers actually stand out. You know, there isn't anything that you can say, I can isolate this, and that's the reason it was better than expected. What you're seeing more is a continuation of the trend that's been set for quite some time. So what we've seen literally is that food prices remain subdued. It increased a little bit over the month, but nothing too dramatic. And then what we're still seeing is the impact of a strong currency and also very weak household demand. So although household demand might have recovered in the first quarter, it's coming off a very low base. It's still quite vulnerable and it's still quite frail. And as a result of that, retailers find themselves in a situation where they still have to discount to move stock off the floor. So we're seeing falling prices for durable goods, for vehicles, for those sorts of heavy imported durable type of products.
Well, you speak of a continuing trend here, Nicky. I mean, we've got, of course, this inflation number lower into the Reserve Bank's target range, but there are some questions about being able to sustain this moving forward, with electricity tariff hikes, fuel hikes, and calls getting louder for above inflation wage settlements as well. What's your view on the sustainability of this trend?
Well, we certainly think we're near the bottom in terms of inflation. There are some forecasts out there that is far more optimistic than ours, but we feel that we are near the bottom. I mean, a lot of Eskom's tariff increases, they will start to come through, I think it is in July, and from there on you'll slowly see inflation start to tick up as far as we're concerned, but it will be a slow increase in inflation, and we anticipate that it will remain within the Reserve Bank's target range for 2 years. So it's going to be a very gradual climb, but the trend, yes, will turn.
You also mentioned that we saw, you know, the impact of a stronger currency. Now we've got the local unit seeing some weakness against the dollar, really tracking the euro at this stage of the game. Local factors hard to push through, you know, and have an impact, one would assume, with all going on in Europe. So what's your outlook on the local currency, the movement we're expected to see there, and impact moving forward on inflation?
Well, the rand's strength has been good for inflation, but of course it hasn't been so good for exports, and it hasn't been so good for economic growth, and it certainly has eroded the country's competitiveness to some extent. And so you can probably make the argument that the rand was starting to look a little bit toppish prior to this bout of weakness, and consequently this kind of correction is maybe just healthy and necessary, and restores us to some degree of competitiveness on a global scale. But to quite frankly, to say where the rand's going to go is very, very difficult. Our forecast is that you will have this volatility for some time to come. What we've got is the return of risk aversion, which is not necessarily based on logic. It's based more on panic and concern about Europe, what that would mean for growth, the threat of a double dip, concerns about banks in Europe, and certainly the North Korean situation just adds to the overall murky picture. So as long as this risk aversion prevails, you'll see the rand weaken. There's little doubt about that. But we might see the rand weaken slower because of the World Cup, because of generally positive sentiment towards South Africa. But I think once the World Cup is done, the rand will probably depreciate again. It will start to weaken, and we expect that weaker trend to persist really until around the third quarter of 2011.
So with this being the case and the growth picture looking better as well, given yesterday's GDP numbers, what's your outlook for rates? Is it still as clear-cut as the possibility of rate rises emerging only early next year?
Well, we've got our actual increase in interest rates in the third quarter of next year only. So for us, nothing changes. Yesterday's numbers were certainly good. They were a good GDP number. What I think people must realize, though, is that it's coming off a low base. So even though the economy grew by 4.6%, some of your industries, there were strong base effects in some of those sectors, most notably finance and real estate, which has been dismally weak, and despite the growth we saw in the first quarter, it's still weak. Credit conditions are still weak, and as well as wholesale, retail, motor trade. All of that is still weak. It's still at weak levels, but it's coming off a low base, and so you don't have to improve by much to get quite quite good growth numbers. So, and I think the Reserve Bank understands that perspective. They're unlikely to overreact, and they're also looking to the medium term, which is where the real risk lies, and which is when we will really see the European problems start to come back to roost.
So where we've been talking now about the possibility of rate rises, what about rate cuts? Because we've had the OECD release a report this morning saying that overly tight monetary conditions, while confidence remains fragile, may hold back a much needed recovery.
I think absolutely the risk to the global economy is quite significant. In Europe, obviously, the markets have now forced upon these governments early adjustments and painful fiscal adjustments at a time when they really would have rather rolled it, I think, because quite frankly, they're just emerging from recession and they're now in a situation where they have to hike taxes and cut spending and do all of these drastic things. And that undoubtedly will force the most vulnerable economies, like, for example, Greece, but even Spain, Italy, Ireland, it could very well force them back into contraction mode, but it will certainly cap growth, even if they don't enter recession. In the case of Greece, I think it is a foregone conclusion they're going to shrink. So some of these countries are looking very vulnerable. The Eurozone is looking a little bit more vulnerable as a result of that. And so the risk to the world economy, I think, is quite significant still.